Today, we are talking about a new concept in the mutual fund industry, Lifecycle funds, also known as target date funds. Now, Zerodha Fund House has launched what it says are India's first Lifecycle funds, designed to automatically change their asset allocations as investors move closer to their financial goals. But the question and concern is, how do these funds actually work? Who should invest in them? And can they really make long-term investing simpler for Indian investors? Now, to answer all of these questions, we are joined by Vishal Kapoor of Zerodha AMC. Vishal, hi, good evening. Welcome to the Money Show. And well, congratulations for this first ever launch of Lifecycle funds. But let's talk about the product and innovation itself. You've called this India's first target date mutual fund. Now, why has it taken so long for the category? We know there were no regulations earlier, and now we do have them. So definitely we are moving, to a solution-based product category also. But what is the biggest problem that these life cycle funds are trying to solve?
Good evening, Kavita. Pleasure to be on your show. Thank you for inviting me. Again, we're extremely happy and excited about launching, India's first life cycle funds. I think it solves many basic problems that investors face. In my 30 years of experience, I find that everybody struggles with, the first thing, which is, where should I put my money? So if somebody had to build an asset allocation across equity, debt, and commodity, I think most of us struggle with, where do I start? How much do I put in? In something like in a life cycle fund, this allocation is defined upfront and it's transparent from day one. The second problem that I find that most people face is staying the course for the entire period of your investment. I mean, markets go up, markets go down. Sometimes headlines get scary, and that's exactly when most investors make their worst decisions, right? In the life cycle fund, this discipline is kind of built in. You don't react to market movements. It's a predefined formula which keeps working at the back end of the fund. And the third, perhaps, the most underappreciated problem is knowing when to shift from equity to debt as your goals approach. So some people stay in equity too long, get hurt, just when they require the money. And many others, shift to debt in the early years and therefore miss the compounding that the equity markets give. The life cycle funds glide path solves all this automatically. I mean, it de-risks your portfolio gradually on a predefined schedule. So you don't have to make that, call under pressure. It's a formula where automatically every year a small portion of the equity keeps going into debt. So moving from a risk asset into a lesser riskier asset over a period of time, over the period of the product.
All right, let's just understand the asset allocation mix for 2036 and 41, definitely depending on the time horizon or the investment time period, the equity allocation changes. So within equity, what's the exposure like in both of these funds, and also across asset classes, how are you placed?
So when you look at the 2036 fund, the 2036 fund starts with 65% allocation and about 10% in commodities, and the rest 25% in debt. And the 65% equity moves all the way up to down to 20% over a span of about 10 years or so. When you look at the 2041 fund, it starts with an equity allocation of 80%, 10% in commodities, and 10% in debt. And this 80% moves down all the way up to 20% over a fixed, 15 years.
All right. I want to understand how can you actually align it with your financial goals, because these are solution-based products. I get that. But, we have a lot of financial goals. People, want to buy their dream house, their kids' education, their retirement. People also have short-term goals, which are their aspirations, basically. And if one has the right kind of financial strategy, even those goals can be achieved. But then, how can one align it with the financial goals? If you could just explain by an example.
I mean, for somebody who's, well, let's take a simple example that you are saving for your child's education needs, 15 years down the line. So the simplest thing for you to do is to, go invest in a 2040 fund. As I mentioned to you, the 2040 fund will have an allocation of 80% equity, 10% in commodities, and 10% in debt. And slowly, as it comes towards the goal, that means the 14th, 15th year, you will find that the equity portion comes down to nearly 20%. So all that you have gained in terms of the higher equity allocation in the beginning period of the product, which has given you the returns, slowly, what you're doing is that the allocation is becoming more conservative. So whatever you have accumulated in the initial years of the product moves towards preservation in the latter part of the product. And that is how you move, from a high risk asset allocation to a low risk asset allocation, so that when you're moving towards maturity, you are preserving what you have earned in the previous years, basically.
All right. What's going to be the cost of an investor to invest in these kind of funds?
So at this point of time, we have not finalized the TER because the TER depends on many factors, and we need to factor in those assumptions even based on how much we raise in the NFO. So just before the allotment is done, we'll be declaring the TER of the fund at that point of time.
All right. It's very important to help our viewers understand the right kind of placement of these funds in their portfolio. Now, what if someone is really very well diversified? How can they have a life cycle fund, adding to their financial goals, or maybe the portfolio mix already, Vishal?
I mean, you have, all sorts of investors. There are some investors who, prefer to, build their own portfolio. People who kind of, like to time the market, build their own asset allocation, and are kind of prudent in terms of, what they want to do. But there are a lot of investors in the market who just want a ready-made solution. So I think this product is, fantastic for those products because it's something simple, it's automated, it handles the basic needs for them in that sense.
Okay. One thing that's very important is definitely the asset allocation part that one really needs to align. But then a lot of questions come around the market conditions and the market timings. If an investor's target period is almost about to get over or is getting over and there's a sharp fall in the market, how can this kind of fund then just reduce their losses or maybe doesn't ride away their returns?
No, so as I mentioned to you, because this is an automatic glide path where, progressively over the life of the fund, the equity allocation comes down. So even towards the last few years of the product, even if the markets move volatilely, in a volatile manner against you, because your equity allocation is very limited, it will not impact the portfolio returns beyond a point.
Do you think life cycle funds could eventually replace balance advantage funds or aggressive hybrid funds for long-term investors? Why or why not?
No, I think I don't think the comparison is quite right. If you look at BAFs and aggressive hybrid funds, they're perpetual vehicles. They don't have a finish line, and so they're designed to run indefinitely. And most of these funds kind of move their allocation based on market conditions, right? They reduce equity when valuations are high and increase it when the valuations are low as per the fund manager. But life cycle funds are completely different, right? The fund doesn't react to any kind of market movement, right? It follows a predefined glide path based entirely on time. That means how many years are left until your goal. And I believe that's the main distinction. So I'd say that these two categories serve genuinely different investor mindsets, I would say. One is for goal oriented investors who have a particular date in mind. The other is for those investors who don't, or who don't have a kind of goal in mind at this point of time. I think both products will coexist, both will grow, because both the needs are very real and both are large.
All right. How much investor education will be required before people trust an algorithm glide path instead of market allocation decisions themselves, Vishal?
I mean, I think education will form a big part, in a journey ahead. I mean, we're quite, certain that adoption won't happen overnight. When you look at it from our perspective, I mean, we're very excited with the product because it fulfills a lot of basic needs for investors. And when you look at a country like India, if you want more and more people to start investing, you need simple, fill it, shut it, forget it kind of products in the market, which are very easy to understand as well. So we think that it fulfills a basic need. Obviously, it'll require a lot of education, but we're in it for the long term. And whether it's talking about it through channels like yours, or making short form content, long form content, or creating blogs and talking to people, is something that we've already started and will continue to do as we go ahead as well.
Absolutely. All right. So I'm assuming this is going to be a passively managed fund, both of these?
Yes. So at the back end, the portfolio will be managed passively. The equity portion will be invested in the Nifty large mid cap 250 index, which is basically a 50-50 split between the top 100 large cap companies and the mid cap 150 companies. The debt portion will be managed through government securities, and the gold and silver portion will be managed through gold and silver ETFs.
All right, so that's the Target Date Lifestyle Fund. Thank you so much, Vishal. With that, it's a wrap on the discussion also. Thank you so much for taking your time out and helping our viewers understand every aspect of this particular fund and have a better strategy that's aligned with the financial goals today. Thank you so much for being a part of this.